The following segment is sponsored by Xterra Incorporated, trading on the TSX Venture Exchange under the symbol XAG.V. Xterra plans to become a mid-tier producer of silver and base metals through the development of its Bilbao deposit located in the central Mexican mineral belt in the state of Zacatecas, as well as through additional exploration and acquisition opportunities. Find Xterra on the web at xterra.ca. Join me for a conversation with a frequent guest of the show, David Morgan, the Silver Guru, an expert on money, metals, and mining, also a lecturer and an author. Mr. Morgan has written Get the Skinny on Silver Investing, available on Amazon.com. His website is themorganreport.com. David, welcome back to the program.
Alice, it's great to be with you.
You know, David, I've been looking at commodities prices lately, and in addition to gold and silver, platinum and palladium have taken a bit of a hit. Copper has taken a bit of a hit. One of our sponsors, who we've spoken about on this program previously, Prophecy Platinum, they have an asset in the Canadian Yukon that's fairly substantial, outside of politically sensitive areas such as South Africa, Russia, and Zimbabwe. Platinum is 15 times more rare than gold. Why aren't we seeing significantly higher platinum and palladium prices?
Well, there's a lot of chatter on the internet about what the natural ratios are of these metals. Platinum several times more rare than gold than it is. And then the silver natural ratio to gold right now is about 9 to 1. So for every 9 ounces of silver out of the earth, there's 1 ounce of gold presently extracted. And so people would think, well, geez, it should sell at that same ratio. But platinum arguably is 15 to 30 times rarer than gold, and it's selling roughly the same price as gold. So the ratio is important, and it could give you an idea that it's undervalued or overvalued relative to another metal. That doesn't necessarily mean that it's got to be priced at the exact ratio of what it is in the earth. It just doesn't have to be that way. It's basically, in a real free market, it'd probably be closer to that, but it is the market's demand. So the platinum and palladium story are pretty interesting. It's something that I follow fairly well. Very few in the gold-silver space really follow them hardly at all. But I think the most interesting thing, by the way, Alice, I'd just like to interject here that from about 2011 to very present time, within the last month or so, I made a decision to basically stop writing in the public domain. I, of course, write with others, the team for the Morgan Report. It basically had all 2011, 2012, and almost all 2013, so almost 3 years where all of the information we put out in the public domain has either been done by video or audio, like this interview we're doing today. And recently I thought maybe I will go ahead and put pen to paper, so to speak, and start publishing again. So we're doing it kind of on an interim basis where we're going to publish my work for the public probably twice a month or so, maybe monthly, for a while, probably 6 months. So I just want to interject that. Coming back to the article, the part about the platinum and palladium article that I really liked the best is it allowed me to answer one of the biggest questions I've gotten again and again and again, and one that very few people seem to know about, even precious metals aficionados, and that is the hypothetical, well, what happens, when there's a shortage of silver? Well, what will happen? Will the exchange close? And the answer is, one, truthfully, we don't know exactly what will happen. But we have a historic precedent that was set in the palladium market. And I wrote about it in this article. So if you haven't read it, I suggest you do if you're interested. What happened in the palladium market was that Ford Motor Company decided, and this was going on in other vehicle production lines, that it was cheaper to use palladium than it was to use platinum in catalytic converters. In fact, at the time, if memory serves correctly, it was at least half the price, if not a third the price of platinum. So it was a very economically based decision. You'd have a higher profit. Of course, you had to retool slightly and close down the line for a small amount of time. But when Ford went to procure the amount of palladium that they needed to interject it in all their catalytic converters, that one company drove the price up over $1,100 an ounce. Now, as that was happening, because they need physical. You're not going to get a piece of paper with a contract that says 100 ounces of palladium and be able to put it in your assembly line. So the futures exchange upped the amount of margin that was required to hold a futures contract to twice the price of physical palladium. So palladium was at $1,100 per ounce, and at the top of the market, you had to post the cash of 2 times that. So in other words, it not only went to a cash market, it went to a 2 times cash market. This is an absolute fact, and you can go check it out. So that may give us an idea of what could happen in the silver market if, as Ted Butler especially had said, credit more to Ted than probably anybody else, and I've said it myself, but Ted especially, that there could be a day where the industrial demand, commensurate with the investment demand, drives silver sky high, because as the supply dries up, and you have to have the physical metal, then these companies that need it, which for silver is vast, because it's not only automotive companies, but it's electronic companies, Apple being one of many, that will need the product, and as they see the supply getting taken away, they're going to bid up the price and then demand physical. So it could get into kind of a feeding frenzy. It's really hard to make that statement today with silver barely above the 2050 critical support level, but nonetheless, that is the potential silver, and I believe it will take place, or something similar to that will take place probably within the next couple of years. The palladium story is in the history book. The palladium story is a fact, and it's just ridiculous when you think of it, that, to have a paper contract, you've got to pay twice the amount of what the physical price would be.
Well, who can afford to do that?
Well, basically no one. I mean, I'll go a little deeper here. You'll believe me, but I had I had 4 contracts in palladium, because I trade all the white metals, and I trade gold as well. And it's one of those markets that's very thin. There's very few traders in it at all. And it started to move. And as it started to move, I had to put up $10,000 more for each contract. For all sudden, a couple of $40,000 to continue holding. And of course, it got up from there and up and up and up and up, as I just said. So I basically backed off and made a slight profit, but a good percentage profit. But when you're using leverage, you wait for those types of opportunities when you're in the futures markets. Some of those moves like that, if you play them right, can very much change your lifestyle, or at least add to it significantly. So had I been able to hold on, it'd be $100,000 per contract, $440,000 at the top. If it could happen, I was able to hold on. As I said, it got beyond the point of absurd. You had to put up more money to hold a piece of paper versus the real deal.
So you were making money on your contracts for as long as you could hold on to them.
Yeah, I got forced out of it. Once the move started to happen, and of course I didn't realize it at the time until just a matter of weeks later what was really going on. But, I'd already been, I could have come up with $40,000, in the business days and get it into my broker and all that. It's like, okay, well, I'll take the profit, get me out, kind of thing. And this happens in the futures market, not just in the metals. It's happened in other futures markets as well. But oftentimes at some of these big runs, you'll see the little guy kind of get forced out because most people are undercapitalized with their positions. And so I could have done some smart things for a little bit. I could have sold 2 contracts, maybe cashed those in and met the margin requirement, but I wouldn't have lasted very long because it increased it so drastically.
Do you think this potential move with platinum or palladium, let's say, because these are industrial metals, could overlook gold, since gold is more speculative, and go right over to silver, and all of a sudden we're seeing a run on silver, which is much more abundant than the platinum group metals? There's new discoveries all the time. The output is not decreasing with regard to silver. What are your thoughts?
Well, it's an interesting question, and the answer, whenever you use could, the answer is yes. Would is a different word. Yeah, I think it could. I've always believed, and I'm on record many times as having said I think that silver outperformed gold in this bull market, and really it has already. People that don't study the market avidly might not believe that, with silver, well over 20 and almost 1,300. But at the beginning of the bull market, silver was under 5 and gold was around 250. And so if you start where silver broke out, the ratio is 80 to 1, and today it's 60 to 1. Well, it takes 20 less ounces of silver to buy an ounce of gold now than it did at the beginning of the bull market. So obviously silver has outperformed gold. I think it will continue to outperform gold. But one of the quote-unquote problems with silver is it is so volatile. That ratio has been as low as 35 to 1 in this bull market so far. That was very temporary. It didn't last at 35 to 1 very long. It's been this high. It said 80, and if you want to really be technical, there was a day or two during the 2008 crisis, on paper anyway, it was about 90. So obviously silver can be extreme on its moves up and down. But in the long-term trend, as an investor mentality, you would take the idea that silver will outperform gold. Coming back to your question, yeah, I think there is a possibility that could take place. That's something no one ever thought about palladium, for crying out loud. Palladium is one of those, again, very thin markets. There's very few futures traders who even bother with it. The price movements, for the most part, aren't really that significant. And then all of a sudden, a big industrial demand comes in, not really very well thought out by Ford Motor Company, and it just blasts the market to a height. At the time, I forget the exact price of gold at the time. I really don't recall. But what I do recall is that 1,100 was far higher than the gold price at the time. Far, far higher. And gold was, I'm going to guess, it's 500-ish or something like that.
And that's not even factoring in the growing demand for automobiles in China, which have been driving platinum and palladium prices, even though they're a bit flat right now.
Well, I'm drawing on the topic, but I'll stay on it. The platinum and palladium both are such small markets. I don't even know why they have a futures exchange for them. I think they should be a cash-only market. I mean, I won't name the depository, but I've visited more than one in my life. I've been to some of the biggest, and one of the largest ones held a lot of palladium plate, and they opened up the safe, that it was a large safe, relatively speaking, but small relative to this facility. And I looked in there, I looked at the plate, and this is the industrial type of palladium that you see, not coins like, you might have as an investor. And he shut the door, and I went about my business and, checked out a lot of other things kind of near the end of the tour when I saw the palladium. And then I got home, and I thought about it later, and I did some, mental calculations, kind of what's commonly referred to as the back of the envelope. And I realized that what I had witnessed in the palladium market, physical, was like a lot of the palladium market. I mean, a significant amount of the palladium market, physically, I saw it. And I started to kind of laugh to myself, thinking, geez, that is such a small market. And I see all these little plates stacked up together in this large safe, and they're held in these little holders that were made for them, I guess. And I thought, as I said later, man, I actually saw a lot of the amount of above-ground palladium. So anyway, it's just one of those things. I mean, you look at like a palladium market versus like oil. I mean, there's just no comparison, even though they're both quote-unquote commodities. I mean, I think about that as well. I'm kind of going on tangents on this interview, but every time I just got back from Munich, as you know, and any big city like that, and just look at all the taxis and all the automobiles and the airplanes and the trucks and on, and you think, geez, that's just Munich. Think of all the other cities that are sucking diesel and gasoline right now, today, at what rate? So, the oil market is just vast. I mean, truly a commodity. Whereas palladium, considered a commodity, but geez, it's such a rare, small, infinitesimal market compared to some of the other commodities. It's, again, in my view, it's one that's vulnerable, certainly. You could corner the palladium and platinum market pretty darn easily if you cared to, but of course, with the powers that be being what they are and the rules in place, they can do exactly what they did last time. In other words, you want to stay in the futures market, that's fine, just pay twice the price of what it actually costs, and we'll let you keep the contract. So.
We'll be right back. The Ellis Martin Report is sponsored by Xterra Incorporated, trading on the TSX Venture Exchange under the symbol XAG.V. Xterra is a Toronto-based resource company, and their primary project is the Bilbao silver-zinc-lead-copper deposit situated in the Panfillo-Natera district of Zacatecas, Mexico, approximately 50 kilometers south of the state capital of Zacatecas, where Xterra is currently completing a bankable feasibility study. Between the company's Bilbao, Laguna, and Panfillo projects, Xterra has a resource of 100 million silver equivalent ounces, including 33 million ounces silver in 43101 compliant resource. Zacatecas is a well-known mining district with infrastructure in place. Mining opportunities are both open pit and underground. There are no significant environmental issues, and there is an available local workforce there, as well as goods and services for development of the projects. You can find a full investor prospectus on Xterra's website. Just log on to xterra.ca or find their logo and click through on the homepage of our website, ellismartinreport.com. And we're back. During the course of our experience and time in the mining sector, we see various flavors of the year. We saw graphite buzz, uranium, rare earth, and rare metals. That was fairly substantial, yet it was a bubble. Even though there are not enough platinum and palladium reserves in the world to support this, what's to keep a plethora of junior mining companies from popping up touting these metals and stocks?
Well, two comments. One, all markets really, if you study them, go from undervalued to fair value to overvalued. And we've certainly seen the overvaluation, I'd say, in the uranium sector. I mean, uranium was one that, I won't name the company, I actually know them like one of the guys involved with the company, but it was such a ridiculous name in my view. I thought it's got to be the top, everybody's out there with some uranium deal. And as you said, it happened to rare earth elements and on and on. So it's normal market behavior for things to get overvalued. I think the bigger question, of course, is are all these precious metals and other resources overvalued totally, and the top has been seen, or are they going to get more valued? My view is strong that they are temporarily got overheated, I'd say, but not necessarily overvalued. I think really high valuations are out in the future, but I also look that to be in the 2016, 2017 time frame. The other thought is that the commodities markets are so cyclical. I mean, if you study them again going back, you will find that they get to a point where they're very underappreciated, very low price, and there's very little of them. And a shortage develops. And the shortage develops when they're pretty low in price. And so then everybody goes out and starts to see the price starts to rise, so then they become economic, and then they start to get like fair valued. And as that's happening, you get more and more mining of the particular commodity, if it's a mineable commodity. And then you start to get an oversupply. And then you see the price come down again. And then weaker companies fall off and they subside, and then you start the cycle over again. So you go from, again, underproduction, low price, gets scarce, no one can stay in business, but they're running out of it, so prices start to move up, and then again, the cycle repeats. So that's kind of a layman's view of what happens. You can look at, iron ore, you can look at copper, you can look at any of the minables, really. I mean, that's pretty much the story. Again, I think to repeat, because I don't want to scare people, I think that not only have we seen that already with China being the prime driver, but the bigger question is it done or is it not done? And of course, there's those that think that perhaps it is. And there's others, such as myself, that think, no, it isn't. And I want to make a caveat on that. Perhaps it could be on the industrial side. In other words, on your industrial metals, being, your copper, lead, zinc, that type of thing. Although I doubt it. I think zinc has got a really bright future a couple of years out. But even if that were the case, and again, I doubt that, but if it were, the top tier metals, precious metals, gold and silver, not necessarily platinum, palladium, although they would ride along with them, are a unique class. This is money. This is outside of the industrial base, although silver is used in industry, obviously, but primarily in a situation where there was uncertainty or greater uncertainty or greater fear or market uncertainty, which is all the things that we have now. Once you see a crack in the bond market, a crack in the stock market, and you get fear back in the market of what are these paper assets really worth? What is the counterparty risk? Am I really going to be able to cash out, or is this paper really going to be worth something in the future? When you get those kind of questions, then there really are very few asset classes to go to. Basically, it's gold and silver, what I call the top tier of all the commodities. And so, since those are such small markets and there's such a vast amount of other assets, meaning primarily bonds, cash, and securities, equities, that the run into those markets could be substantial. For a quick example, and again, a back-of-the-envelope type of calculation, but you might have roughly 1% invested in the silver market, for example. And if you were able to double that to 2%, you would have double the demand for silver than you have right now. And that is huge as far as doubling. So it's a 100% increase in demand, but it's only 1% increase above what the whole total asset breakdown is currently. And I think that's very achievable. So the idea that the metals are dead or they're not going to go up or this or that, really it's a psychological thing. And so far, if you want to call them the manipulators, the managers, the market itself, I don't care how we got. I mean, I care how we got here, but we're here regardless how we got here. Whether you believe in the management of the prices or not, we're here. And that's the fact. And the other fact is psychology's been broken. People that thought that silver was a great buy at 30 or 35 that bought then, or even higher, are disgusted and the psychology's been broken. It's not a good investment. It's never going back up. And that's what they want. I mean, these markets, the manipulation, if you want to call it that, or the market price action, if you want to call it that, will take people into these emotional states. People don't buy rationally or logically. They buy on emotion, and their herd instinct takes over. So when their neighbor's buying silver and he bought it at 30 and now it's at 35, but he's making money, geez, I'm going to get on too. And it goes up to 40, you feel like a genius. 45, oh, I'm really smart. But then it doesn't last very long. And then, of course, this 2-year bear market within a secular bull market has been really, really tough on precious metals investors but some will acknowledge that there was a 10 or 11 year run in gold. I mean, gold had like a 10 or 11 year consecutive year-over-year gain. And it's only been the last bit here, the last couple, that gold has gone down, sideways to down. So that's markets, and I think we're probably near the end of that. I think we're going to start building a base of coming back up. But even when we come back up, if you bought at 35, for example, in silver, I'm not sure you're going to see $35 silver in 2014. I think it's 230. So, you might have to wait until 2015 to see that 35 silver. Of course, again, I have to emphasize that, there's black swans out there and one might land on the barbecue tomorrow morning. I don't know. There's so many things that could ignite this rather quickly, but unless that happens, I think we're going to have to grind our way higher.
Well, you said it's psychological. Isn't it true that 0.5% are involved as investors in the precious metals market? What would it take for the investor super conscious to get into their heads that silver is super cheap right now and that you should probably buy some if you don't already have some and buy more if you do? It's both an industrial metal and a speculative metal. Would it take you getting on TV more often telling everyone that?
Yeah. Well, it's going to be alternative media, the alternative analysts. I mean, I did see a lot of the presentations secondhand from the Silver Institute, and I know some of these guys, but they basically just gloss over or don't even mention the investment demand in the silver market, which is rather significant. I mean, we all know that study the silver market, even at cursory level, that the amount of Silver Eagles purchased was like 40 million ounces, another new record, even at these dull, unexciting prices. So silver demand for investment is rather robust, even though you would not hear it from the mainstream financial channels. It's a, again, psychological thing. I don't think it takes me on TV. Thanks for the plug. The point is, we are going to see it happen regardless, because, as I mentioned earlier in the interview, there will come a time when there's doubt raised by the investor themselves that has bonds or has stocks or has a currency or money in the bank or that type of thing, and starts to say, you know, this deficit thing isn't getting under control. Russia's backing away from the dollar. China's backing away from the dollar. Germany's backing away from the dollar. They can't get the gold back. Something's going on. I think I'm going to put some of my assets. You know, gold actually, probably it's low right now. I think I'll buy some. So the psychology comes on a kind of an individual case-by-case basis, and then all of a sudden, you know, the low price isn't so low anymore. It starts to work its way back, and that's how markets are made. And then it will become popular again. And this time, the next time it catches the momentum traders and the hedge funds are coming in again, and they see the ads on TV running again, and that type of thing, I think it's going to overwhelm what we saw last time. What I said last time was, as bizarre as it went from 19 to 48 for the silver market, that was a warm-up. Get ready, because the next move up is going to make that one look like, again, a warm-up. I think you're going to see silver and gold go into the record books this time. And the reason they're going to the record books isn't because they're such special commodities, although they are. It's that the fiat money experiment is going to fail on a global basis. And that's something to think about. Think about that statement. The fiat money experiment is going to fail on a global basis. We've never had that happen in history before. That's what's monumental. It's not the gold and silver. They're elements. They're known as money. They've been sought after and all that, and it's all true. But they're just elements used and preserve wealth, or perceived to do so. But the real fact is that the whole world has caught on to this fiat, we can print wealth idea, which of course is a lie. And that lie will die. When that lie dies, you'll see the currencies die. And when they die, then you're going to see a repricing in paper terms of gold and silver that who knows where they'll go.
So what I'm hearing, which is something we've spoken about very recently, is that you think it's a good time to continue to stack silver, and you're still interested in the silver stocks as well.
Yes, the stocks is where the real value is right now, but boy, it's been very, very hard. We just had one of the most significantly high-grade situations that we've ever had, and it's very near production, and it seems like management just cannot get their act together. I don't want to blame anyone, but the stock price does what the stock price does. We just put out an alert explaining the best we can. We don't think we've made a mistake. Certainly, you know, the markets make mistakes. I mean, forget the term, but this market theory that everything is factored in the markets, I oppose that view totally. There'd be no reason to invest if that were the case. Markets make errors. I'm not a fan of Warren Buffett's, but as Warren Buffett refers to Mr. Market, I mean, if Mr. Market is going to give you a discount on something, why not take advantage of it? And if Mr. Market has marked something up way beyond what would be a reasonable value, you probably ought to take a profit on it. So Mr. Market, in my view, has taken this particular company to a level that it's hard to believe it's at this point. But those that have invested higher, such as yours truly, it's painful, especially, you know, when there's enough pain anyway. And then you get something that gets chopped another large percentage in a trading session. It can grind the best of us.
I've been receiving a constant bevy of emails and alerts from you as I'm a subscriber to your website and service, themorganreport.com. You've got a great staff of individuals that work with you that basically cover everything we need to know about these commodities.
Well, thank you. We do our best. I mean, as corny as it may sound, we really do take everything to heart. We don't like it when these things happen. We don't back away either. We might not get an instant response out to everyone because we like to be careful and objective and double-check our facts and that type of thing. But we do respond, and we don't hide. If we make an error, we tell you we made an error. In this particular case, I finished up writing it, and one of the other staff people helped me do some of the data. I don't see that we've made a mistake. Later on, I found out we have. Of course, I'll admit that. But one of the best in the industry is pretty darn high on this company, and we did an interview with him a few months back, and that was as a subscriber part I'm referring to. But the price is wrong, in my view. And, of course, the problem with these speculations is just that. You really should only put in money you can afford to lose. And all the time I get the question, well, which one's your favorite? What's your favorite? And that's really hard. I mean, you could say, well, could be your favorite because the grade is higher than any other grade. But I learned a long time ago the hard way not to have any favorites, to buy a basket of them. Because no matter how good a company looks, something can go wrong. And this business will show you that again and again and again. And some people say, well, it's higher grade or it's this or that, and therefore, rather than put X amount into 5 stocks or X amount into 10 stocks, I'm going to put 5X into this one or 10X into this one, and geez, that's a way to get hurt. And the reason I know that so well is that's what I did as a youngster when I just started investing in the resource sector when I was in my early 20s. Even though I started investing before that at 16, actually, but I was doing more on the DJI kind of, more the blue chip type of investing until I started learning more about the metals markets. But regardless, I put too much in these penny stocks and learned the hard way that if you're going to make big money in the mining sector, you ought to put big money into big companies and little money into little companies. And if those little companies become big companies, you can always add to your position. And I've done that successfully on this cycle. But certainly those opportunities have not manifested here in the last few years, as we well know.
Well, David, once again, another compelling interview. Thanks so much for joining me today on the program.
My pleasure.
I've been speaking with the Silver Guru, David Morgan. The website is silver-investor.com or themorganreport.com. You can hear the segment again on the podcast page of our website, ellismartinreport.com. The preceding segment has been sponsored by Xterra Incorporated, trading on the TSX Venture Exchange under the symbol XAG.V. Xterra plans to become a mid-tier producer of silver and base metals through the development of its Bilbao deposit located in the central Mexican mineral belt in the state of Zacatecas, as well as through additional exploration and acquisition opportunities. Find Xterra on the web at xterra.ca.